Silver investors, you just watched a $10 smash that made your screen look like a crime scene, but the vault data and global price spread say this wasn't a real crash. It was a ghost market shakeout in the thinnest liquidity week of the year. Before Monday's opening, you need to decide which price you believe, the flickering number on your app or the weight that's quietly fleeing Western vaults toward the east. I'm OG John AG, and in this video, I'm going to show you why silver fell from $85 to under $75 in hours, even though nobody was really selling, how Comex just slipped under 100 million ounces of registered metal with 3 people claiming every bar, why Shanghai is paying $95 an ounce while New York pretends silver is worth 76, how industrial demand is eating 5 years of structural deficits, and what that means for you before the real move starts after this ghost weekends. Segment 1. The 2 a.m. convenience store market. Picture this. You walk into a convenience store at 2 in the morning. The floor is sticky, shelves are half empty, and the price tags are flickering like a bad disco light. That's exactly what the silver market looks like in mid-February 2026. Silver has just plunged from $85 an ounce to under $75 in a matter of hours. $10 vanished faster than a politician's promise. Gold, meanwhile, is still sitting around $100 like nothing happened. Everyone is screaming crash. But look around. Who is actually selling? Where are the big blocks of physical hitting the market? We're not in a panic stampede. We're in a double ghost town. In the east, the Shanghai whales have shut their terminals to eat dumplings and celebrate the Lunar New Year. In the west, Wall Street pros are packing bags for President's Day. What's left is a few interns, some high-speed trading bots. Liquidity so thin, a single sell order echoes like a bomb in an empty cathedral. So the first rule for this weekend, close the flashing tabs. Don't let red candles hypnotize you before you look under the floorboards. Segment 2, the iguana effect. When lizards run the market, if you were watching live streams yesterday, you saw it. A moment of pure panic over a lizard. A giant iguana walked behind a YouTuber. He jumped out of his chair, and for 30 seconds, the chat forgot about trillions of dollars to spam lizard in all caps. That iguana is the perfect metaphor for what happened in silver this week. The market saw a shadow, thin liquidity, a technical break, and jumped. The algorithms that run a huge part of this market are basically nervous lizards with fiber optic cables. They saw price dip below a key technical level. They all rushed for the exit at the exact same time. Result, cascades of stop losses, forced selling. A $10 vertical line on your chart. But here's the comedy. While the screen shows a $10 drop like no one wants silver, the physical vault data is screaming the opposite. The lights on your broker app are flashing, but the plumbing beneath the system is what we need to read now. Segment 3, Comex, the empty ATM machine. Think of Comex like a giant ATM for Western silver. For years, everyone walked up, put in their card, and assumed there was cash inside. This week, the maintenance log dropped a bomb. Registered silver, the metal with a for sale sign, has fallen below 100 million ounces for the first time in years. The latest print is around 98 million ounces. On paper, 98 million sounds like a mountain. In global finance, it's a pebble. At current prices, about $7.5 billion, less than the market cap of a mid-tier meme coin, pocket change for Apple or Microsoft. Here's the banker trick. They point at the eligible category and say, relax, there's plenty of silver. That's the 3-card Monte. Eligible silver or metal sitting in the vault, but owned by someone else. It is not for sale. Counting it as available supply is like me pointing at your car in your driveway and telling the bank it's my asset. Yes, it's there. No, I cannot legally sell it. The only pile that matters for price discovery and delivery is registered, and that pile has dropped around 25% just since the start of the year. The ATM is running out of cash, but the screen still glows, inviting people to make withdrawals. Now add the March contracts. There are roughly 65,000 open interest contracts for March delivery. Each represents 5,000 ounces. Do the math, 65,000 at 5,000, 325 million ounces of paper silver people think they own. But we just said only 98 million ounces sit in registered. That's a 3.1 ratio. 3 people think they own the same bar. When the music stops and it's getting quiet, only one gets silver. The other 2 get a fiat check in a currency being debased in slow motion. This is classic fractional reserve banking, except the deposit isn't dollars, it's ounces. Segment 4, Backwardation, the matrix glitch that proves the smash was fake. In a healthy commodity market, the future price is higher than the spot price. You pay someone to store the metal, insure it, finance it. That extra cost shows up as contango, futures trading above spot. Right now in silver, we're seeing the opposite. backwardation. At several points, the price to get metal today is higher than the price on futures for next month. That's a glitch in the matrix, a siren going off. The market does not trust that the metal will actually be there in the future. Traders are willing to pay a premium for immediate delivery instead of holding a paper promise. This backwardation is the smoking gun. It proves the $10 smash was a paper event, a derivative illusion, not the story of a world drowning in unwanted silver. If there were a true surplus, futures would be much higher than spot. They're not. So why smash price $10? Because if you're short, you love thin liquidity, you love holidays, you love retail fear. They pushed price down into the ghost week 2, trigger stop-loss orders, margin call the overleveraged, shake real positions loose so they can cover naked shorts cheaper. It's a Black Friday sale in reverse. They're marking price down because they desperately need to buy it back before everyone realizes how rare the metal is. Segment 5, East versus West, two different silver realities. While the West plays screen games, the East is playing weight games. Let's look at China before the holiday shuttered markets. Spot silver in Shanghai hovered around $84 an ounce. To move that metal out of the vault into a factory, you add 13% VAT, putting the real industrial price near $95. In New York and London after the smash, paper silver traded around $76. Do the math. 95, 76 versus $19 gap. Even if you throw in $2 per ounce for shipping, insurance, and security, you're staring at a risk-free $17 arbitrage for every ounce moved west to east. This isn't some tiny mispricing. It's a smuggler's dream and an economic black hole. If I told you you could buy iPhones in New York for $500 and instantly sell them in Beijing for $800, what would you do? You wouldn't buy one. You'd charter a cargo plane and empty every Apple store. That is exactly what's happening with silver bars. Metal is flying out of London and New York vaults into Asia. The West is suppressing price on paper, effectively writing a massive discount check to Chinese industry. The cheaper they make it, the faster it leaves. It's a self-defeating loop. Segment 6, Shanghai's 90% inventory collapse. This is a bank run. Now flip the camera fully to Shanghai. Inventory data shows silver stocks on the Shanghai exchanges have plummeted over 90% since 2020. They're down to the bone, near 10-year lows. Just this past Monday, right before the holiday, Shanghai recorded an 8-9% drawdown in a single day. Nearly 1/10 of all available exchange inventory vanished in 24 hours. That is not grandma buying extra coins. That is industrial panic, strategic accumulation. This is what a bank run on silver looks like in slow motion. Solar manufacturers, EV makers, and military contractors aren't watching memes. They're watching tank levels and long-term contracts. They know silver is finite. Mine supply is not keeping up. Western paper games are a once-in-a-lifetime chance to lock in cheap feedstock. While you see a red candle and think, I'm losing, they see a discount and empty the buffet. Segment 7. 5 years of structural deficit. The hungry industrial monster strip away the drama. Look at the math. For 5 consecutive years, the world has consumed more silver than miners can pull out of the ground. A structural market deficit. The Silver Institute's data shows the solar industry alone is now devouring nearly 20% of annual silver supply. New, more efficient solar technologies use even more silver per panel. Add to that EVs and charging infrastructure, high-end electronics and 5G, AI data centers and advanced chips that need silver for thermal and electrical performance. Silver isn't pirate treasure. It's the blood in the veins of the digital and green economy. When the paper price drops $10, does a solar factory in Shanghai say, oh no, the chart is bearish, stop production? No, they say, thank you for the discount, and buy more. So every smash does 2 things at once. Scares speculators, accelerates real-world shortages. It's like telling a starving teenager hamburgers are half price. You don't save inventory, you run out twice as fast. That's why spot on your screen is drifting away from the real street price. Try buying physical at 75 right now. Dealers laugh, or tell you out of stock. Premiums on coins and bars are exploding because dealers know the rule. You can print currency and derivatives. You cannot print silver. Segment 8, price versus weight. What you can hold versus what can be canceled. Right now, you're dealing with 2 different silvers. Screen silver, a number on an app. A derivative price set in thin liquidity by lizards and leverage. Weight silver coins and bars in vaults and factories. The stuff that keeps servers cool, missiles guided, and grids alive. Screen silver can gap $10 in an hour. Weight silver moves only if miners find, dig, and refine it. Logistics actually deliver it. Comex registered inventory sliding under 100 ounces is the sound of the banker grip slipping off the beach ball. They're using margin hikes, contract dumps, and holiday timing to shove that ball deeper underwater. But physics doesn't negotiate. The deeper you push, the more pressure builds. The emptier the vaults get at suppressed prices, the more violent the snap when you lose control. You have two choices. Scenario A, believe the screen. Dump real assets for paper currency being printed faster than you can say QE. Hand your wealth to the same people engineering the shakeout. Scenario B, believe the wait. See out-of-stock signs, $19 east-west arbitrage gaps, and 5-year deficits for what they are. Either do nothing or treat this $10 drop as a gifted discount, but only with no leverage, no hero trades. This week isn't for gambling, it's for watching and positioning. Segment 9, what to watch before Monday and beyond. As we head into Monday's open and the rest of this ghost week, here's your checklist. Comex registered inventory. Watch if registered keeps bleeding lower despite the price smash. Falling metal plus falling price. Confirmation, this move is paper, not surplus. Backwardation versus contango. If spot stays above near-month futures, distrust any narrative about too much silver. Nobody wants it. Shanghai reopening. When the dragon wakes up and sees silver on sale $10 off, watch if demand in Asia spikes further. A renewed draw from already 90% drained Shanghai levels would be a huge tell. Physical premiums, call dealers, check online spreads. If spot says 75 but coins are 90, 95 with delays, the truth is in the premium, not the Comex tape. Industrial signals. Keep an eye on solar build-out numbers, EV production, and defense budgets, all silver hungry. If those 5 all point the same direction, tighter metal at lower price, the conclusion is simple. The price isn't discovering value, it's discovering how scared traders can get in a ghost town. Segment 10, final word before you act. So where does that leave you before Monday's opening bell? We're standing in a digital ghost town watching a glitchy ATM spit out paper receipts while the real money flies to China in cargo holds. The lizards and algorithms are confused. The charts are lying, but the vault levels and shipping routes are telling the truth. If you can hold it in your hand, it's real. If it's just a number on a screen, it's a promise that can be changed, halted, cash settled, or redefined when it suits the people in charge. The Comex ATM is on fumes. The East is draining the West. The industrial monster is still hungry, and this ghost week will end. When traders come back from holiday, they're going to find a very different landscape than the one their algorithms pretended to see this Friday. You've been watching John AG here, and I'm OG John AG. If this helped you see why a $10 dump in a holiday ghost town tells you more about liquidity than about silver's real value, hit like so. This kind of forensic breakdown doesn't get buried. Subscribe and turn on all notifications, because the next time the iguana runs across your screen, I want you watching the vault levels instead of the lizard.